Hey there, we're live. It's Mitch Goldberg. You're watching Be the Boss of Your Money. It's my post-market show about the market, personal finance. I put it all together, give you insights, perspective. The whole idea is to make you not just a better investor, but better with your money, better with financial decisions. You have financial decisions every day, but you have big ones throughout your life, and they have consequences, and you want to get it right. Now, not everybody can get everything right. In fact, nobody gets everything right. But we want to make sure we make the best decisions we can with insight. And we want to make sure we have the insight to change our mind and pivot when we need to. Did somebody say pivot?
Pivot! Pivot!
All right. So we're going to roll the introduction real quick, but we've got Facebook with the most massive turnaround. Stock flew higher today, lifted the whole NASDAQ in aftermarket trading. Amazon, huge earnings. Stock is way up in aftermarket trading. And the beat goes on, and the Dow, the NASDAQ, S&P, all the major averages were just up very big today. Very good day, and erases all the losses from earlier this week and sets this week up for a really good week. Pending any like disaster tomorrow, we're going to have a pretty good week. Here we go. Thank you for joining me. I'm Mitch Goldberg. We're just getting started. Just want to say that when it comes to indexes, when I talk about the S&P 500, the Dow, the NASDAQ, any index, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. And diversification, which we think is important. Diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. There, I said it. So let's get into the market. Let's just move some of the garbage off my desk. Someone said to me yesterday that my office looks like Hammermill in a hurricane. Yeah, I got a few things to clean up. And the more paperless I get, the worse it gets. I don't get that. Who is out there? I'm laughing. We referenced that clip in our family, and it was in my mind. I'm so glad, Renee, that you commented. Thank you very much. I'm glad I could make you laugh because, there's no better joy than making somebody laugh. Well, I love to make myself laugh too. Thank you very much. I'm glad you enjoyed that. I got a whole bunch of those in the clips here, But let's take a quick look at the market just to get that out of the way. All right. So I want to take a look at stocks. Here we go. Dow is up over 500 points. Good day, right? NASDAQ up almost 2.5%. That's almost 300 points. S&P 500 up almost 80, up just about 2%. Gold up a little bit, but remarkably still under 2,000. I'll tell you why in a second. Oil, wow. You know what? We talk a lot here. We follow oil almost on a daily basis. I would say 4 to 5 days I track the price of oil, but oil is below 75. Let's take a look, just a quick look at oil. All right, let's see if we could pull up a chart on oil. By the way, if you have any questions, ask me in the comments, whether if you're watching the live or the replay. If you have any questions about what we're talking about, ask me. It doesn't have to be just about what we're talking about. You could ask me anything about personal finance, stocks, investing. If you want to get in touch with me and take this to a one-on-one conversation to talk about your financial plans, investments, etc., that's what I'm here for. I help you get to that point. My philosophy is this. I believe you have an investment and financial plan that is exactly right for you, and I can help you find it. That's what we do. That's why it's worth having a phone call with me, and hopefully I will. I believe I will save you years of time and energy to find what's right for you. There's a lot of value, okay? Let's take a look at this. Let's look at year to date. In fact, let's take a look at the last 3 months, okay? right here. All right, March 17th. That was right after. You see where the X is down here? See that? That's right over here, March 15th. This is when, right around that time when Silicon Valley Bank blew up, taking the bank stocks down with it and adding fuel to the recession is coming fire, because now banks would pull back on offering credit, thereby further raising the potential of a recession. Okay. And as a result, oil plunged down to $65 a barrel. And it's been in a range between 72 and 82. But this really broke through the bottom of the range. And then all of a sudden, what happens? Right about over here, OPEC, right over here, OPEC says, we're cutting, was over here, it was like over here, whatever, OPEC that right after that says, we're cutting like 1.1 million barrels of production from the market. Oil spikes all the way up to 83. All right. So it spikes up to 83. And where is it now? It's at a little under 75. So oil is back to the mid-range. It's back to the mid-range of its trading range. You saw the price at the pump skyrocketing last couple of weeks. It should start to come down again. And it just goes to show you that there's really not that much control OPEC has over the market. Everybody who cuts production cheats. Russia is selling oil to China and India at rock bottom prices. And there's worry that we could go into a recession, which would crimp demand. We'll talk about that more in a moment. And the VIX was down to 17. The VIX has been consistently low for this entire year. So this has been like a really tame year as far as volatility. I mean, today is definitely, I think, the biggest up day that we've had this year so far. We've had like maybe one or two somewhat big down days this year. That is very little, considering we're at the end of April already. Tomorrow is the last trading day of April. When we come back Monday, it's already May 1st. And it should be, we'll see how things are set up. Now, the talk is that there's a recession coming. We all know about it. We talk about it here all the time. You hear about it in the news all the time. And I have to, I'll give you the three scenarios. We might have a soft landing where the economy slows down enough that it feels like a recession, but statistics still say we're not quite in a recession. So it's slowing down the economy enough to tamp down inflation. There are those who say we might completely bypass a recession and just, do that soft landing and slowly rebound. So a no landing. And then there are those who say we could have a hard landing, meaning we go into a hard recession and we feel it. We don't know yet for sure. Labor is still pretty strong. It's been weakening, meaning it's not been as strong as it was, but it is still strong. Unemployment is still very low. Next week, we have the Fed meets on May 3rd, and they're expected to announce a quarter-point hike in their federal funds rate, which will mean that they took interest rates basically from 0 to a range of about 5 to 5.25%. And in the time frame, a little bit over a year that they've been raising rates, it's been a rapid cycle of increases. And I don't want to say it's the biggest in history. I think like 1980 was maybe the one time that the Fed raised rates much faster than what we have now. But we're now just starting to see the effects of the Fed rate hikes impact the economy. And we're seeing, we're expected to see the effect of banks pulling back on lending. I talked about that a lot in my radio show, and I try to make I try to make sure we're not missing anything. When banks take in your deposits, they use that money to put assets on their balance sheet. And they make money from those assets. Now, just so you know, that your asset is the bank deposit. You put money in the bank, it's your asset. But because the bank is paying interest on it to the bank, your deposit is their liability. Just want to be clear on that. The banks are borrowing money from you for very, very low rate. And then they take that money and they make loans, or they buy bonds that pay interest, and they make more money with those activities than what they're paying you in the bank. And that's how banks make money. Net interest margin. But banks, and the more deposits that banks have, the more they could do that. They could invest that money into things that make the bank money. But when you have the bank fallout, for the Silicon Valley Bank and Signature Bank collapse, that means a lot of small and regional banks saw their depositors fly out. They withdrew their money and they put it into bigger banks. And the big banks are the beneficiary of this. J.P. Morgan, Wells Fargo, Bank of America, Citi, the big banks where depositors feel comfortable. Those banks were the beneficiary of all this money. So, but when a bank, like a regional bank or small bank, loses that deposit base, they don't have enough deposits anymore to support the assets that they have. Therefore, they have to start to sell the assets and sell them at fire sale prices. I'm giving you this because I want you to know how a credit squeeze works. So I'm telling you this because you need to know that banks have to pull back on lending because they don't even have the deposit base in many cases to make more loans, like to businesses, who's a big borrower from banks. Therefore, it slows down the economy. So we could go into a recession. Some say we're already in one. I sometimes think we've already had it and came out of it. So maybe if we go into another one, it's a double dip recession. We really don't know until after the fact and a few years go by, and then we could look back with more clarity and all the economic statistics are updated and refined, and then we could say, or then we could see, what happened. And Renee, thank you so much. Renee, wish I didn't have a 4 p.m. meeting. I'll have to catch the rest on a replay. Great content. Hey, thank you so much. That means a lot to me, and that's why I do this. Thank you. Okay. So we could see a recession. We probably will see one. And then why is the market going up? We talk about the stock market and the economy in an interchangeable way, like it's the same thing, and they're not. Well, the market's up, but we could go into a recession. And as I said to my friend Paul during the Great Recession about 12, 13 years ago, what does the economy have to do with the stock market? Stocks could still go up. Corporate managements are still working to make their companies more profitable. Not all companies make it through a recession. Stocks could go down, they could go up. But there's so many other things that impact a stock that besides the recession. There's so many things that impact stocks besides the economy. And now you're seeing large cap tech stocks just flying right now. They're really not impacted by the economy. The businesses, the consumers that they serve are spending money on these platforms regardless of what else is happening in the world. That's why they're in such a sweet spot right now, these companies. And they've been in a sweet spot. Not all tech companies, Pinterest and Snap are tanking in the aftermarket right now. I guess people thought if Facebook had good numbers, they should send Snap up. But remember, this is a battle of David versus Goliath. And right now, Goliath is clearly winning the battle. Bigger is better. If you're spending advertising dollars in social media, you're going to spend on bigger platforms. If you're putting your money in the bank, you're going to put your money in bigger banks. If you're a business banking client, you want to move to a big bank. That's the trend now. I'm not saying it's better. I'm not saying it's worse. That's what people are doing now because they want to feel safe. So that's one way it works. So let's talk one more second about that. We might. So if we have a recession, it could be shallow. We just don't know yet. But the important thing is, the important things are this. This is the most prepared that we've ever been for a recession. We've been talking about a recession for so long now that it might actually be factored into the stock market. It might be factored into business spending plans. And the world, the investing world, I should say, is looking past it already. And if the Fed stops raising rates, they don't have to necessarily cut rates right away. But the Federal Reserve has a lot of room now to cut interest rates if we do go into a recession. The other thing is inflation is coming down. And I want you to think about this, what I'm going to say right now, because you're not going to hear this from anyone else. The Dow Jones Industrial Average is just a few percentage points away from hitting an all-time high. A little bit further to go for the S&P, and even a little more than that, a good deal more than that for the NASDAQ. But what we need to take a look at is inflation. Inflation is coming down. There is a possibility that inflation comes down so much as the rest of this year goes by. We have to be prepared for the S&P 500 going to a new all-time high this year in the next 8 months. It could happen. I've seen crazy things happen in that many times. I've been doing this for over, I've been doing this for 33 years of my life. We could see the market hit new highs, and I think the bears on the market have it wrong. We have to leave room for the possibility that good things happen. That brings me to some of the biggest winners of the day, which I will show you now. I just want to punch one up. I'll just get a quote for you right now. We have to look at Meta, which is Facebook. Facebook changed their name to Meta, and it was up almost $30 today, up about 14%. Hit a new 52-week high. And the stock is now, how much is it up this year? It's up almost 100% on the year, making that the biggest winner in the S&P 500 this year, even doing better than what was the biggest winner yesterday, which was NVIDIA, which is up about 85% this year. You have to leave room for these kinds of possibilities. Now, it's odd that, not odd, it's the usual. Every time techs go up, and these techs went up because their numbers are phenomenal, because they're perceived as a safe haven in some ways. Look at this. This is Amazon. It's up almost 7 in aftermarket trading. It was up almost 5 today. It's up about $11, $12 overall between today's regular trading and aftermarket trading. It's a big move for a company the size of Amazon. Every time these stocks go up there, there's going to be somebody yelling, "It's a bubble." Listen, not every single time that stocks go up is a bubble. These stocks are way off their highs. The excess has been taken out, and the stocks that should never have been up as much as they were, from Roku to Peloton to Zoom, DocuSign, Teladoc, which Teladoc had a good day today. But these stocks have basically been, taken down by 80, 90% in value from their pandemic peaks. All right? Doesn't mean that everything's a bubble every time the market goes up. Bond yields, you could still get a good yield, 5% in a 6-month, 4-month, and a 3-month T-bill. But if you notice, not so long ago, all of these numbers started with a 4 or 5. Now there's a lot of 3s, 3 years, 3%, 7, 10-year, 20, even the 30-year has a 3 handle. And that's telling you that long-term rates are going up. It's telling you inflation is believed to be headed lower, not higher. That's why I said before, when we looked at gold, that there's a reason why gold can't hold 2,000 the ounce at the moment, because it's perceived that what makes gold great, inflation, is not so great right now for gold anyway, because inflation looks like it's peaked. And the interest rate hikes from the Fed, we're just starting to feel these now. Combine that with banks pulling back on credit, everything's more expensive. And we had the GDP came out this morning, up 1.1% versus expectations of 2%. So GDP comes in late. GDP comes in light. gross domestic product, it's the biggest measure of how the economy is doing, was a little bit light. So I think the economy is slowing down enough to maybe get one more rate hike from the Fed, maybe two. And I know that's very consensus, but we could see inflation come down pretty quickly. We could see new highs on the S&P 500, not just the Dow. The Dow is not far from making a new high. The S&P 500, that's the big daddy. That's the metric that we want to see move higher. That's the index. We could see it. And I think you need to make room for that possibility. That's why you shouldn't be so negative. Last thing. All right. The screen froze me for a second. I hate when that happens. Last thing. The American Association of Individual Investors, that's AAII. Here it is. Pat myself up in the corner here. AAII. Make that bigger so you could see it. Pessimism remains above average for 10th consecutive week, but bearishness have been on the rise. And investors have gotten so overly negative from a contrarian stance. Stocks were ripe for the picking, and you're just seeing a lot of stocks show substantial gains. And these are some of the big stocks that have an impact on the Dow Jones, the S&P, and the NASDAQ. Another reason why we need to sometimes separate the economy from the stock market. They are not the same thing. With that said, thank you for watching. It's Friday, so I typically don't do the live stream on Fridays unless something absolutely crazy happens in the market. And if nothing crazy happens in the market, I'll be back Monday. Have a great weekend, and thank you so much for watching. Bye.